Okay, perfect. So we are going over chapter 2. It is the types of life policies. There's the most content from this chapter on the actual exam. It's the longest chapter. So once we get through it, you're going to be feeling really good about the study information. So feel free, unmute yourself. If you have any questions as we're going through it, it's meant to be interactive. So just unmute yourself, ask questions as much as you need to, and we will go ahead and get going. So the first type of policy, all right, that we're going to talk about is term insurance. So term insurance is known as pure insurance, meaning it doesn't have any cash value or savings account or any other bells and whistles linked to it. It's just specifically a life insurance policy that gives you, pays you a death benefit if you die during a certain period of time, okay? So that's what term life insurance is called, pure insurance. So if you see anything that talks about what type of insurance is known as pure insurance, that will be term insurance, okay? So there's a couple different kinds. It's super simple. There's level, increasing, and decreasing. What that increasing, decreasing, or level describes is what is happening to the death benefit. So as you can see up here, the death benefit is level, okay? They will ask you when they say increasing death benefit or decreasing death benefit, they'll say, what does that refer to? Is it referring to the premium, to the face amount? And they'll give you a bunch of different options, okay? So term insurance is described by what happens to the face amount or the death benefit up here. So level term insurance means that the death benefit stays the same for the entire policy. You'll notice with this level term, this is just the most plain type of term insurance. The face amount's the same, premium is the same for the entire policy. It could be a 10-year, 20-year, 30-year, whatever term it is, they stay exactly the same, all right? This one is also a level term insurance because look at the face amount or the death benefit. It stays level, okay? So it stays level, but this one is called annual renewable term insurance. So annual renewable term insurance is a type of level term because that death benefit stays level. But look what happens to the premium. Every single year that you own the policy and you get older, your premium gets more expensive. So in the beginning, somebody can be like, okay, I'm going to buy a term policy. Looking at two companies, this one's obviously cheaper. Like, I'm going to go with this one. So they'll get the annual renewable term policy, not realizing how much it's going to go up every single year. So 3-4 years in, they're like, this is way more expensive than the other one. That would have been locked in the entire time. But now their health may have changed. They may not be able to qualify for insurance, or it might be more expensive or whatever else. So these policies are meant to lock someone in. And then once they find out it's going up, they're like, well, we can lock in your rate by converting this to a whole life policy. So they'll convert it to a permanent whole life policy, which is very, very expensive. All right, so annual renewable term insurance, type of level term insurance, but remember, the premium is going up every single year. You might see a question about annual renewable term. When it renews each year, you do not have to reprove insurability. Okay, so if you are gonna buy additional coverage, you have to reprove your insurability. You have to do a medical exam, you have to prove you don't have stage 4 cancer since the last time you asked for insurance. But with annual renewable term, the face amount is not going up. The death benefit is not going up, just the premium. So you're paying more and more money, not based on your health or anything else, because you're not getting more coverage, okay? So with annual renewable term, when it renews each year, you do not have to reprove insurability. Decreasing term, look what's happening to the death benefit. It's decreasing over time. So that's what describes the decreasing term, okay? Why would anybody ever want a policy like this, where the longer you have it, the less coverage you have? This is used for credit life insurance. So when somebody owes a debt, let's say you owe the bank $100,000. If you die, the bank's like, how are we going to get our money? So they can require that you buy a life insurance policy to cover just that amount that you owe them. So if you were to pass away before you owe that before you paid that 100,000 back, then this life insurance policy will pay what you haven't paid back yet. Okay, so a couple of caveats to that credit life, which we'll study more in great detail later, is that they can never be paid back more than what you owe. Okay, so that's why the term is decreasing, because every time you make a payment, your debt is going down and down and down. So as you make payments, you need less and less insurance to cover you to pay off that debt if something were to happen. Okay. So premium stays level the entire time, but the face amount goes down as you pay off that debt. So that is decreasing term used with credit life insurance, with mortgages or other debts. Return of premium term, they don't have a picture for it, which that kind of annoys me, but it's whatever. So return of premium term, what happens is the death benefit is actually going up because if you die during the term, they will give you the death benefit and they also give you however much you paid in premiums into it. So they give you the death benefit plus however much you've paid. So they're returning your premiums. So the way they sell it is like, listen, we'll pay you if you get to the end of the policy and you haven't died, then we give you all of your premiums back that you paid. So it's basically like you had free insurance the entire time, and they get added to your death benefit whatever you paid if you died during the policy. So it's an increasing death benefit. It sounds really good, but the time value of money is more powerful than that. So what's happening is the company is charging way higher premiums for this type of policy. They're investing that money, they're making interest off of that money, and then they're just giving you it back, an interest-free loan basically for that entire term. So it's not actually smart if you do the math, but that is how it works. So the death benefit goes up with return of premium. It's considered an increasing term. There's not going to be a whole lot of questions on it. Just know return of premium is a term policy. It's an increasing term policy. All right. Special features. Renewable. Renewable means you can renew the term for another term. Very simple. Convertible means you can convert the term from a term policy to a whole life or a permanent policy. So you can actually change the type of policy that it is. So renew is like, give me another term. Convert is you actually change the entire type of policy to a permanent or whole life policy. All right, traditional whole life products. So that was 4 term products. We had level term, super simple, plain, same death benefit, same premium. Then we had our second type of level term was annual renewable term. That was the one that looked like the stair steps. So it gets more expensive every year, but it's still considered a level term because the death benefit stays the same. Then we had decreasing term where the death benefit goes down over time. Then we had increasing term, which is the return of premium term because you have the death benefit plus whatever premiums they've paid, okay? So 3 different types. Level, there's 2 different ones there. Decreasing and increasing, 4 altogether, okay? That make up the types of term policies. Traditional whole life products, there are 3 different types. So basically the difference between whole life and term is this line right here going through the box. It's the cash value. So whole life insurance is meant to last your whole life. It costs a lot more money because the longer you're going to guarantee your health, the more expensive your policy is going to be. So the longer term you have, the more expensive it is. The longer policy you have, the more expensive it is. So whole life insurance, it costs about 10 times on average what a term policy does. So a term policy for a young 20-something might be $10 per 100,000. So if you get a $100,000 policy, you're paying $10-15 a month for someone who's young and healthy, maybe in their 20s. That same whole life policy would be like $100 per 100,000. So it's very expensive insurance. And what they do is they take part of your money and they buy a term policy inside that whole life one. So it gives you coverage up here. You're paying level premium, and then little by little, part of the money you pay each month goes into a cash value account. Okay, so whole life, straight whole life, ordinary whole life, those are all different names for it. Straight life, ordinary life, just simple. Level death benefit, level premium, a cash value that slowly, gradually grows over time. Limited pay, the second type of whole life policy, is identical to this one. Only difference is, look at this premium. It's scrunched down there to where it ends early. Okay, so that's what they call paid up insurance. Someone's like, oh, my policy's paid up. Like, I'm not going to switch it now. And it's like, hold up. Like, the insurance company's not just giving you free insurance. They overcharged you like crazy on the front end. So what they do is they take this premium, the amount that's due on the entire length of time. So if I owed you $1,200, you're like, okay, pay me $100 a month at the end of the year, we'll be good. And you're like, or you could pay me $200 a month, and the last 6 months I'll give you for free. You won't have to pay me anything. I'm paying you the same amount of money. It's just scrunched down into a shorter period of time. So people feel like they're getting something for free, but what they're actually doing is losing the time value of their money that they could be investing, okay? But that's how it works. So it's the same amount of premiums. They just scrunch it down and increase the amount that they're paying each month. And it's usually paid up at 65, like the couple of names of policies that you'll see right here, 20 pay life. That means they're going to pay for 20 years, whenever they start it for 20 years. Or paid up at 65 or LP 65. That means that they're going to pay it until they turn age 65 and then it will be paid up. So those are the most common ones that you're going to see. Identical again to the whole life. They're just paying off the premium early, okay? Single premium, third type of whole life policy, all right? Identical to the top one as far as the death benefit goes, but look at the premium. There's no dotted line for premium. Why? Because it's a single premium, meaning single payment. Premium means payment, okay? Premium means payment. So premium, single premium, let's say grandpa passed away or they have their retirement or something else. So they're like, oh, I have this $20,000. What should I do with it? The life insurance guy's like, oh, I have a great investment for you. And there's life insurance too. Let's drop the 20,000 into this life insurance policy. You'll get a return on your money. You'll have life insurance coverage. So they drop that check into the whole life policy one time and they never pay premiums again. And the entire policy is paid up for the rest of the policy. So here's the question you're going to see on this. It may ask what out of the 3 whole life policies, or they'll say out of the whole life policies or permanent policies, which type has the lowest monthly premium? The answer is this first whole life, because it's the lowest, because it lasts their entire lives, so it's lower, it's less. This one is more, and this one is the most. The other answer, or the other question that you'll see is what type of whole life policy generates immediate cash value? Immediate cash value. The answer is single premium, because when you dump in that 20 grand, normally with this whole life policy, your cash value will be 0 for usually 1 to 5 years. Usually 3 years is the average. That you'll see no money in your cash value account. Where's all that money going? Agent commissions, policy fees, administrative fees, a bunch of other fees that have fancy names. Okay, so normally that cash value takes a while to start accruing. With a single premium, you drop 20 grand in there, that pays off all that crap immediately, and then you have money automatically in your savings account because you paid off everything since you put such a huge chunk in. So which whole life policy generates immediate cash value? It's the single premium, all right? Single premium. Remember that? All right, we're getting into the next type of permanent insurance. These all have like kind of lots of little bells and whistles is what some people would call them. I like to call them, I can't say fraud legally, but I'll say there's a lot of fine print, a lot of loopholes in these types of policies that can catch people off guard that they don't necessarily know is in there. Okay, so let's go over a couple of these. Adjustable life, it's not usually too popular a topic on the test. What you need to know is that everything can change. You can increase or decrease the premium or the premium paying period. You can increase or decrease the face amount. You can change the period of protection. You can convert it from term insurance to permanent insurance or back to term insurance. So you pay more money for this policy, but you can make lots of changes. There's lots of flexibility. Just remember that everything can be adjusted because it's adjustable life, all right? Next is universal life. All right, so before you read anything on the page or we get into like the official terms of anything, let me tell you how a universal life policy works. A universal life policy is an annual renewable term policy. Remember how we went over the stair steps at the beginning? It gets more expensive every single year. So that is the type of insurance that is inside of a universal life policy, an annual renewable term policy. So what happens is they tell you, this policy has flexible premium. You can decide how much you want to pay. You just tell us if you need to adjust it, we'll adjust it. Okay, so people are like, well, that's awesome. Like if my money's tight, I can just adjust my premium. So they set a premium for you to pay. There's two different types. There's minimum premium and there's target premium. So let's just say you're paying $200 a month. When you first start, the cost of insurance, you're paying $200. The cost of insurance is $50. So they're paying the $50 towards the annual renewable term insurance. Remember, that goes up every single year, but it's cheap at the beginning. So only $50. That leaves $150 minus some fees, minus some other things they like to charge you. But then they put the rest of that money into your cash value or your savings account. So the difference, whatever is left after they pay the cost of insurance, goes into your savings. Well, what happens? The next year, your cost of insurance goes up. Let's say it goes up to $100 a month. Now they take out the fees and everything else. Now what's left? It's getting closer and closer. Fast forward 5 years. What happens when the cost of insurance is $200? You're paying $200. Fast forward a little further. Now let's say the cost of insurance is $250, but you're still only paying the $200. How do they pay that cost of insurance? They take it from your savings and they don't even have to tell you you're doing it. So they take money out of your savings and they use it to pay for the insurance. Then what ends up happening is they drain the savings. The insurance keeps getting more expensive every year, and now they're using it to pay the difference till the insurance gets so high, the savings goes to zero, and then they have to send them a letter. And by law, it says they have to give them 30 days notice to tell them that their policy is going to lapse. So the conversation goes, hey, I know you were paying $200, but now your cost of insurance is $1,150 a month. So you got to start paying the $1,150 or your policy is going to cancel. And the people are like, what? What? I can never afford that every single month. Like, what am I? Just give me my savings and I'm going to go. And they're like, there's nothing in your savings. And they're like, what happened to my savings? Well, it was being used to pay for the life insurance this entire time. By that point, people are usually later on in life. They may be uninsurable. Their health may be bad, whatever else. And then when that policy cancels, any savings that they may have borrowed from the policy or used other than just for premiums, they have to pay taxes on as soon as that policy cancels. Okay, guys? So this policy is terrible every way you look at it, basically. And when you look at the policy and do the math, it's easy to tell that. Does somebody have a question? I heard somebody come off mute. Anybody? No? No? Okay. So what you need to know for the test is that your universal life policy is a flexible premium, meaning you can adjust how much you're paying monthly. You could say money's tight this month. I'll give you twice next month. The reason you can do that is because if you don't pay enough, they're going to automatically take it from your savings account. It's called an automatic premium loan. All right. So the minimum premium is the amount you have to pay to keep the policy in force for that year. So if the cost of insurance is $50, the minimum premium that you would have to pay just to keep the policy in force would be a little higher than 50. It'd probably be like 75 or something to cover all of the fees that it takes and the cost of insurance. Okay, so that's just to keep the policy in force for that year. The target premium is how much extra over the amount that the insurance currently costs do you have to pay to get so much accumulated in the savings so that you never completely run out of savings, so it can cover that rising cost of insurance inside the policy. Okay, so minimum premium is the amount you would need for that year. The target premium is the amount you would need to pay to keep the policy in force for its entire lifetime. All right. Yes, what is it?
How do you properly counsel a insured policy of that sort?
Yes, so it depends on how long they've had it, what's in the cash value, if they've borrowed from it at all. So what we would advise people to do would be dependent on their situation. So number one, are they insurable? If they've had a heart attack, a stroke, cancer, a lot of things like that, we got to make sure that we can get them covered first. So we would take an application to see if we can get them qualified for insurance. And then we would look at their policy and say, have you taken any premium loans? How much is in the savings? And those types of things. So you can put a stop payment on the policy so that no more premiums will come out while we work on getting them covered with us. And then based on their specific situation, we can recommend that they cancel it or surrender the policy, depending on how much is in their cash value. Sometimes it's best to take the cash value out and then cancel the policy so that you get the maximum amount. But we would make that recommendation to someone based on their specific situation, because it would be a little different based on someone's numbers and situation. Did I answer that question okay?
Yes, thank you.
Okay. If you have one of these, you can talk to me afterwards. Okay, so partial withdrawal. A partial withdrawal or partial surrender is when you take out part of that cash value, but there's usually a charge. So if you're going to borrow your cash value from any whole life policy, you have to pay it back with interest. So if you don't pay it back right away, then that interest starts eating away at your savings as well, which that's all you need, right? Is just something else eating away at your savings. If that savings goes to zero and you can't afford the cost of insurance, your policy cancels. So that's a big deal. So if you borrow money out to send your kid to college, and obviously you haven't paid it back because you needed it for the college, and then your cash value gets too low where they can't afford how high the insurance is anymore, and you can't afford it, and that policy cancels, you have to pay taxes on that entire amount. So let's say you took out 30 grand to send your kid to school. Well, you would have to pay taxes on 30 grand in that 1 year. So if you're making 60 grand at your job, now your taxable wages may have bumped you into the next tax bracket. You would show 90,000 in income for that 1 year. Okay, so a lot of sketchy stuff that can happen in these policies. But here's what you need to know for the test. Option A. So option A, when it comes to universal life insurance, is the level death benefit option. Okay, so see how the death benefit is level here. All up until this point. What is that thing that says IRS corridor? What the IRS corridor is, a lot of people sell these universal life policies to doctors, people who are making quite a bit of money, and they say, hey, this is something you can invest your money in that you don't have to pay taxes on. It's tax-free or tax-deferred growth on your money. And so people are like, oh yeah, this is awesome. Like I can pretty much like kind of hide my money in this life insurance account as an investment. Well, the IRS is like, nah, we ain't gonna be fooled by that. You're using this as an investment because life insurance policies are not taxed. The death benefits are not taxed. They're like, if you're going to use this as an investment, we're going to tax it like an investment. So they do what's called a 7-pay test. If at any point in time, when they look at the policy, if there's more than 7 years paid into the cash value in one of these types of policies, it fails the 7-pay test. And then it becomes a modified endowment contract. So MEC, that's going to be on your test. Also, modified endowment contract, MEC. If it fails the 7-pay test, it becomes an MEC. Once it's an MEC, it stays an MEC. It can never go back to a life insurance policy. So they're going to have to pay taxes on that money, just like they would an investment. All right, so to keep that from happening, they have this little thing called the IRS corridor. So as soon as the savings is getting too high, they're like, oh no, the death benefit is even higher. They're buying a life insurance policy. It's not an investment, it's a life insurance policy. So that death benefit is level the entire time till right at the end, it's just like, whoop, to keep up with the savings so that the policy doesn't turn into a modified endowment contract. Okay, so option A, level death benefit. Option A, level death benefit until that tiny IRS corridor at the end. The second option, option B, is what they call an increasing death benefit. So you see how it just increases gradually over time. With every type of whole life policy except universal life option B, if you die, you do not get your savings. You either get your death benefit, or if you live to age 100 when the policy ends, or endows is another word that they use, or matures. Those are the three terms to use it. If you get to age 100, then you get your cash value, which is equal to the amount of premiums that you paid into the policy. So option B is more expensive, but if you die, you get the cash value and your death benefit. Okay, so this one, same thing. The death benefit stays far enough ahead of the cash value that it doesn't turn into a modified endowment contract. But just know option B is an increasing death benefit. Okay, increasing death benefit just slowly increases over time. And that is basically everything you're ever going to need to know about universal life insurance. Anybody have any questions before we go on to variable whole life? Nope. Okay. Variable whole life, identical to the straight life, the ordinary life, that first one that we looked at, it's identical to that. Only difference is what they do with that cash value account. So instead of it just sitting at the insurance company and them deciding a certain rate of return, with a variable whole life policy, that money is actually put into what they call a separate account, and it's actually invested. So the account is actually called a separate account, and it's invested. So anything on your test that says variable, whether it's variable annuity, variable life, variable universal life, anything that says variable, you must have a life insurance license and an investment license or a securities license. Those two terms and names are used synonymously. So securities license, investment license, same thing. If it says variable, you have to have that license. A couple of things that you need to know, questions that it might ask, it tries to trip you up. So there's two different entities involving the investment license. There's FINRA, FINRA, capital letters, FINRA. They are the ones who regulate the investment licenses. So they regulate, rewind. FINRA registers you to get your investment license, okay? So when you're applying to get it, you're applying to FINRA. So you're registering with FINRA. They're the ones that give you authorization to even get the license, okay? So write FINRA and then write register. Then there's a second one. It's called the SEC, Securities Exchange Commission. They're the ones that regulate. So they enforce the rules once you have your license. So they're the ones that regulate, all right? So they may give you a list and say, which one of the following would you register with to get your investment license? You need to know register is FINRA. If they say which of the following regulates investment licenses for someone writing a variable whole life policy, it's the SEC. So know those because they're both R words, register and regulate. So sometimes that can trip you up. But anything that says variable, you have to have that investment or securities license. Variable universal life, identical to universal life that we just studied. Only difference is that money that's going to the cash value is actually going into a separate account and is getting invested, okay? That's variable universal life. Interest sensitive whole life. So this one, there's not a ton of questions on this either. What you need is, it's also referred to as current assumption life. You may never even see that term on your test. The basis of this is that the cash value account, it provides a minimum guaranteed rate of interest, and it's sensitive to what the market's doing. So it's not invested in the market, doesn't require a securities license, but they say, hey, if the market does 5, then we'll give your money, a minimum of a guarantee of 1%, but if the market does 5, then we'll give you 3%. It has some type of tie to what the market's doing. So interest sensitive, it's sensitive to what the interest is doing in the market, but the money's not actually invested in the market. It's kind of like a parent who gives their kid an allowance and they're like, I'll give you 10% on your money of whatever you have left next month. Like, the kid's money is not actually in the market. The parents are just saying, out of all of our money, we'll give you a little cut. And that's pretty much how these policies work. If they don't say variable, that's what the company is doing. The money's not actually invested. Index life. So index life just means that cash value follows an index, like the S&P 500 or any other index. So if the index does XYZ, then your money will grow XYZ amount. So it just mirrors that, but the money, again, is not actually invested. And that is all of the different types of life insurance policies. Pretty simple. Anybody have any questions over those? I know we're kind of flying through this, but the goal, again, is to help you understand the information, because if you understand it, when you go back and read it later, you're taking quizzes, you're on your tests, you're going to remember this stuff. It's going to pop into your mind. You're going to be like, oh, yeah, that makes sense. So it's just going to help you and kind of boost your study time so that you're able to study faster when you do. So joint life is basically a single policy that insures 2 or more lives. So meaning mom and dad, instead of having 2 separate policies, they're on one policy. It takes the average of their ages, and that is the premium, okay? The average of their ages equals the premium they pay each month. And the way a joint life policy works is that it pays only upon the first death. So once either one of them die, the whole policy goes away. If they had two separate policies, when one dies, this policy is still in force. Joint life is cheaper than having two separate policies because it's the average of their ages and it's just one premium each month. But as soon as one person dies, the policy goes away. So that is joint life. It's based on the first death, the first person to die. The second type down here, survivorship life or second to die, is a policy. Again, it works like joint life where they take the average of their two ages, but it's a lower premium because it only pays when the second person dies. So think about that. The likelihood of two people dying is definitely less likely than just one person dying. So the premium is lower. So you may see questions. So once this person dies, they keep paying the premiums, Once this person dies, that's when they pay the death benefits. You say, why would anybody want that type of life insurance policy? It's usually for like adult people that are paying for their elderly parents to live or supporting kids or something like that, to where they're like, if both of us were gone, we would want these surviving people to have money or to be taken care of. So that's what it's a lot of times used for, is like people taking care of their elderly parents. If something were to happen to both of them, they would want their elderly parents to keep having their bills paid. So that's the most common kind. Just know, joint life is cheaper than two individual policies, and survivorship life or second to die is even cheaper than joint life because both people have to die. So joint life, when the first person dies, that pays and then the policy cancels. Survivorship life, both people have to die and then the policy goes away and the death benefit is paid. All right, we are on to annuities, and that will be the end of the chapter after annuities. So annuities, a lot of times I had no idea what they were before I started working here. My background was in ER nursing, so definitely not anything to do with financial stuff. Really good at CPR, and if you have any body parts that have fallen off, I worked in a trauma center, so really good with that. But annuities, I was like, what the heck is that? Never even heard of it. So an annuity, life insurance, protects you against dying too soon and leaving your families without income. An annuity protects you against living too long and outliving your savings. So if you've saved 100 grand and you retire and you start living off of that money and then you run out, now you're how old? 80? And now you have to go find a job to provide for yourself? Like, that doesn't work, right? So an annuity is a contract that's meant to provide some type of monthly income that somebody can count on for the rest of their life. So again, there's a lot of fine print, there's a lot of loopholes, there's a lot of good things, bad things in annuities. So you really have to be careful. But let's talk about the different kinds. Annuities are one of the simplest parts of your test, but one of the most missed questions, which is why I always want to hit on them, because it just kind of lumps into this big like mess, and people are like, oh, this is so confusing, the way the questions are asked. But once you break it down and learn the parts, it will become the easiest questions. You'll be like, I hope every question on the test is on annuities. Okay, so the people involved in an annuity contract, there is first of all the owner. The owner is usually the same person as the annuitant, kind of like with a life insurance policy. The owner is usually the primary insured, but not always. So the owner can be a business, a trust, or something like that. The annuitant can never be a business or a trust. It must be a natural person, is what they'll call it for your test, a natural person. Because the way an annuity works is they tell you, okay, you're retiring, you're 68 years old, you have X amount of dollars in your annuity based on how much money you have, how old you are, and your estimated life expectancy. We will guarantee you $1,500 a month the rest of your life. Well, that has to be based on someone's life expectancy. If the annuitant was a company, there's no way they could calculate that because companies never die. So the annuitant must be a natural person because they calculate it off of your mortality risk of how soon do they think you're going to die and how likely do they think you are to die. And that's how they calculate how much money they're going to offer to give you, basically. So you need to know that. Annuitant always has to be a natural person. The owner can be a corporation or a trust or something else, but not the annuitant. Those are normally the same people, but if it is different, know that for your test, okay? The next person is the beneficiary. The beneficiary is who gets the money when the annuitant passes away, if something happens during that process. All right, so the owner pays the money into the annuity, and then the annuity pays money out to the annuitant. So normally those are the same people, but that's how that process goes. Two different periods in an annuity. There's the accumulation phase. That's when they're paying money into the annuity. Then there's the annuitization phase, and that's when they're taking money out. So they start withdrawing income payments out of the annuity. So accumulation also could be called pay-in. Annuitization could also be pay out or withdrawing the money or whatever else. So just remember annuity period, annuitization, anything that has those words in it means you're taking money out. Accumulation means you're putting money in. Okay, pretty simple there. Types of annuities. So there's single premium, which we learned earlier with life insurance, just means one payment. Single premium is one lump sum payment. You just took that 20 grand you got from your retirement account or from inheritance or whatever else, you dropped it into the annuity. Single premium, one-time payment. Flexible premium means maybe you put in 10,000 today, but you're adding 500 a month. Or whatever else. Any mix of more than one payment is called periodic premium. Periodic premium, more than one payment. So single premium, one payment. Periodic premium, multiple payments. Next is right here. So the annuitization, when does that occur? If you've saved money into your annuity and then you decide 6 months later, oh, I'm going to retire or I lost my job, I need to start withdrawing income out of my annuity, that's called an immediate annuity. Any annuity that from the date of contract you start taking out money in less than 1 year, that's an immediate annuity. So from the date of contract, if you take out money in less than 12 months, that's called an immediate annuity. If the payments begin after 1 year, that's called a deferred annuity. So these questions sometimes go like, hey, you have, Mr. Smith that bought an annuity and it was a single premium deferred variable annuity. And it's like all these different terms and he's in the accumulation phase. And you're like, oh my word, this was so much stuff. But if you break it down, okay, he's in the process of paying money in. It's a deferred annuity. That means he's not taking money out for at least over a year. And then it's a variable annuity that tells you how the money's invested, which we're about to get to in just a second. So you can just break down the wording in the questions and know exactly what it means. And it makes it super simple. So the last part, I always like going down to that and then coming back up to this. So the types of annuities, once again, just like life insurance, there's 3 different types of annuities, and what it's describing is how the money is invested within the annuity. So the first one that you're going to see here is a fixed annuity. A fixed annuity is the least risky, most conservative. So it's way over here, least risky, most conservative. I need to have a guaranteed check. I need to know exactly what's happening with my money. I don't want much fluctuation at all. So with a fixed annuity, like you can see there, there's a guaranteed minimum rate of return. The income payments don't vary. So once you pick what you're going with, you can count on it every single month. It does not vary. And they guarantee a specific dollar amount for each payment and the length of period, like the period of time that they're guaranteeing the payments for, depending on which settlement option you choose. So you could choose a fixed period of time, like I want my annuity to last for 15 years, or I want my annuity to last till the end of my life, or I need to make sure that I have $1,500 for as long as that lasts, or that's a fixed amount. So you pick your settlement options of how you want it structured, but once you pick that, it's set. It does not change. So fixed annuities, the money goes into the company's general account. Like we talked about before, it's not actually invested in anything. So general account means it's a fixed annuity. General account means it's a fixed annuity. They'll say, hey, this annuitant is saving money. It goes into the company's general account. What type of annuity do they have? Fixed annuity goes into the general account. Fixed annuity has a guaranteed minimum rate of return. The downside of that guaranteed minimum rate of return is the words that they'll use is it doesn't hedge for inflation, or it doesn't keep up with inflation, or it doesn't keep up with market risk, meaning the cost of goods and services is going up like this, usually 3 to 4% a year, So if your fixed annuity is guaranteeing you 2%, that's great. You didn't lose money. But if you're getting a guaranteed 2%, but inflation is 4%, your money is actually buying you less and less goods and services every year. So you're actually losing money. So you got to be careful. That's the downside of fixed annuities. The next one is going to be an indexed annuity. An indexed annuity is also a type of fixed annuity, but with a few differences. So the questions you'll see about an indexed annuity is what fixed annuity aims for slightly more aggressive returns. So we got fixed annuity is most conservative. Then we have indexed annuity is like coming a little bit more to the risky side. All right, so the savings that's in there, they still have a minimum guaranteed rate of return, but the savings that's in there mirrors an index, just like with index life insurance, mirrors an index. So what the index does will give you a mirrored amount to that. Okay, so just know that it mirrors an index, but it's not actually invested in that index. Then the last and most risky type, that word variable, so we have fixed, index is still a type of fixed, guaranteed minimum interest rate. The money is not actually invested. So both of these are considered fixed annuities. Then all the way over here, we have a variable annuity, which is most risky, no guarantees. With a variable annuity, the money is put into a separate account and it's actually invested. So what license do you have to have? If it says variable annuity, you have to have an investment or a securities license to market it. Okay, and that is registered with FINRA and regulated by the SEC. All right. That is, yep, that's pretty much variable annuities. So then there's this really awesome little table down here that just shows you, okay, premium payment options, single premium, one payment, periodic premium, multiple premiums. When will the income begin? Less than 12 months, longer than 12 months. Benefit payment options. Is it straight life? So only for that annuitant's life? Or is there a guaranteed minimum, meaning for my life or at least until the 100,000 that I put in is paid out? So if I die, you'll pay it out to my wife. If my wife dies, it'll get paid to our kids. So guaranteed minimum, straight life, or some type of guaranteed minimum. How many lives are covered? Single life, meaning just the annuitant, or multiple life, meaning the annuitant, spouse, kids can all be included on there. If it's joint, it would be the annuitant and the wife or spouse, whoever it is. So if dad passes away, then whatever check he was getting will go to his wife for the remainder of the contract. All right. If it says joint and survivor, that means when dad passes away, that amount of money goes to mom. And then when mom passes away, it usually, if you see in a question where it says joint and 2/3 survivor or joint and 1/2 survivor, that means this amount that dad was getting and mom got after dad passed away, the kids will now get just 2/3 of whatever that check was, or 1/2. So the survivor will get 1/2 of what the payment was, or 2/3 of what the payment was. That's what that means when you see that on a question. And then underlying investments. How is it invested? One of the two types of fixed annuities or variable, which requires that investment license and is the most risky. So that is the entire chapter, the longest chapter that you have to study, the most content that will be on your test. That is it. So we are done. Anybody have any questions on any of that stuff that I can answer? Kristen recorded this, so we will get that recording and I can post it. We'll both post it on our telegrams so that you have it if you need to watch it again, because I know you're pretty fast going through that, or if anybody missed tonight. But does anybody have any questions at all?
I don't, but can you send me the recording from yesterday and today? I'm not in the Telegram.
Oh, yes.
Yeah.
Yes,
who
we
is
can make
who
sure.
is your RVP, Emily?
Oh no, it was Alexis that was asking it.
Alexa.
Alexis.
Mine,
I'm sorry.
it's okay. Mine is Jonathan and Bria.
Okay, so we are. That's me. Okay. Yeah, so I'll get that to you. I'll get that to the Dingles and have them send it out to you, Alexis.
Okay, thank you. Appreciate y'all.
Perfect. Anybody else have any questions?
Was yesterday's posted on Telegram?